Hey, welcome to the NZ Everyday Investor. My name is Darcy, and today I'm speaking with Jenée Tibshraeny. Now, Jenée is a financial journalist for interest.co.nz, and Jenée specializes in covering the interaction between government and the economy. Do you think that it's still the right plan of attack, using monetary policy as a way to create economic change?
Yeah, so that is a really interesting question. One school of thought is actually that central banks around the world have been really active since the 2008 global financial crisis because governments haven't been as active. So, so central banks might feel the need to, try to lower interest rates to stimulate demand and stimulate spending because governments aren't necessarily spending as much and doing as much as they could. That is one school of thought, and I think there's some kind of merit in that because politicians, if they want to borrow and spend and create, do big infrastructure projects or do things like that to try to create demand and boost the economy, they have to go through all sorts of political hurdles to do that. They might need to relook at the tax system, do all those sorts of things. It's difficult. They need consensus, and people generally don't like change, right? To try to change something is difficult. Whereas there's an argument that they've just offloaded to the central banks and gone, cool, you guys do that. Now, the central banks have been really active and they've done that. They've lowered interest rates, record lows. Other countries have been doing quantitative easing for much longer than New Zealand. It's new for us, but they've been doing it for years. So, yeah, and there are sort of perverse effects of that because as we've seen, lowering those interest rates, that has had a flow-on effect into asset prices, and it hasn't boosted inflation as much. So, like the price of your TV isn't really going up, but then the price of your house is. So, yeah, I think there's an interesting discussion as to whether government's fiscal policy needs to do more. And there are different organisations like the IMF making these sorts of comments.
Right. And I just wonder, at some stage, is the fiscal and the monetary just going to blend into one? And really, it's just, all right, we're just going to combine forces. We're just going to amalgamate central bank and we're just the government now. Do you think that could ever happen?
Keep it simple. I think people are saying that the sort of time of peak central bank independence is over. And I'll just give you an example of how we see that at the moment in New Zealand. So the large-scale asset purchase program, or the quantitative easing, the way that works is that that Treasury, so the government issues bonds, it issues debt into the market because the government needs to take out a whole lot of debt to pay for the wage subsidy and all that kind of thing. And then what happens is the Reserve Bank buys those bonds from the markets, so from ANZ and the big Kiwi fund investors and so on who buy them, and it's committed to buying a whole heap of those bonds. And in doing that, it's basically creating money to buy the bonds and then buying them. And so basically injecting a whole lot of money into the system. Now, the reason the Reserve Bank is doing that is to try to boost inflation and employment in line with its mandate. But if Treasury issues fewer bonds, which it looks like it might, because the impact of COVID might not be as severe as we expected it, if Treasury issues fewer bonds, then the Reserve Bank can't go as hard with its bond buying program. So it might need to wind its QE back a wee bit. That's what, I guess we'll see what happens, but that's what could happen. Instead of doing 100 billion, it might have to do 80 billion, at which point the central bank might have to go, right, we can't do as much QE or bond buying. So now what else do we do? Do we need to lower the OCR? What else do we need to do to meet our target? So long story short, what I'm saying is these two things are separate. What the government does, it issues debt to do things like the wage subsidy. That's separate to what the Reserve Bank does, which is to meet its inflation and employment targets. But there is a crossover because if the government doesn't issue as much debt, then the Reserve Bank needs to look at using different tools to meet its targets. Right. Do you sort of get?
Yeah, I think I do. So what you're saying is there's this mutually dependent. This codependency really at its finest, isn't it? Like you've got to do your job really well, or else we can't do our job, and then we'll be forced to use other tools, which will have a much greater impact for you guys to do your job. Is it kind of the idea?
Yeah, like I guess they're separate. They're both trying to do separate things, but they don't. But they do work together. They do support each other. So So Adrian Orr has been saying that monetary policy is supporting fiscal policy, and it is. They are separate, but there's still that crossover. Is what I'm saying.
Right.
Yeah.
So
and that's not a bad thing. That's just or good thing.
It's just the way it is. Yeah. So they are in, but not of. That's the best way to describe the central bank, right? And it's. I again, there's a lot of linkages here between the separation of the church and state, separation of the financial church and state. Yeah, it's not necessarily designed. All those things it's not designed to protect the government from these institutions. It's the other way around. So again, like what you said before, we don't really want politicians with their agendas reaching too far into this, but ultimately we might be forced into a situation where that actually potentially happens, right? Like that seems to be the course of action that we're going down, where the government is reaching more and more into the Reserve Bank. Is that correct?
I don't think so. I just think what's happening is that we're doing more. We've got heaps of stimulus. Like the amount of stimulus that we're seeing now is like we've never seen before. And it's not a bad thing if the right hand is talking to the left hand, for example. And I don't think, also the separation is also kind of, we've created these structures in certain ways. And I think we are in an evolving world. So it's important to keep looking at the way those structures are and whether they're still fit for purpose. So there was a bit of talk when the Reserve Bank did its bond buying. Some sort of people who were seen to be a tiny bit more out there suggested, well, hold on, if the Reserve Bank's going to print all that money to buy all these bonds from ANZ and from the Kiwi fund managers and so on, if the central bank's going to buy all that debt on the secondary market at a premium, why doesn't the central bank just buy that debt straight from Treasury and cut out the middleman, that's billions of dollars that are being lost through the banking system. So the Reserve Bank basically prints the money, gives it to the government, and lets the government do things like give benefits and maybe cash payments to businesses that need it, or I'm not sure, do some sort of infrastructure projects and so on. Just cut out this middle bit and try to stimulate the economy that way from the bottom up. Now that would require the two working really closely together. And I think back in April, I talked to Adrian Orr and I said, well, what do you think about this idea? And he was like, oh, yeah, that's different, but doable. And it was something they thought about doing. And they ended up not doing it because it would, make the two look too tightly together. But I don't think in this environment, I think it's good to have all options on the table.
I guess it's like anything, right? As long as you can go back, right? Like as long as you can go back to the ideal state, or 'cause the more you fiddle with things, the more side effects get created. It's harder to go back to equilibrium. That you came from, right?
I think we're very far from equilibrium at the moment.
Yeah. It sounds like it. It sounds pretty messed up. So tell me, Jenée, you were at a press conference recently where they were, the Reserve Bank was acknowledging the receipt of this open letter. Do you want to just talk to us a little bit about what that was and just the general vibe of the room?
Yeah, sure. So just by way of background, the government has been coming under quite a bit of pressure because, as everyone knows, house prices have been soaring, and the Reserve Bank, by lowering interest rates, that has played a role, not the only role, but that's played a role in these house prices skyrocketing. So I'm based at Parliament, that's where I am now in my office, and all of us reporters are always nailing the government over these rising house prices. Got to the point where Grant Robertson actually said, okay, I'm going to write to Adrian Orr, write to the Reserve Bank and say, look, we need to discuss this. And Grant proposed an idea to change the remit for the Monetary Policy Committee and for a sentence to be put in there to make the Reserve Bank consider house prices when it changes interest rates effectively. And then that letter was made public, and then within hours, the Reserve Bank responded with the letter publicly as well. So usually when they do these things, they do them behind closed doors. But obviously that wasn't working. So Grant Robertson was like, right, here's the letter, public, big hoo-ha about it. And then Adrian Orr was like, right, response, public, big hoo-ha. And basically said, no, government, we're just doing our job. It's the remit. We have to lower interest rates. We're trying to meet our inflation and employment targets. We do think about house prices already. And actually, if you put that little bit into our remit, then that might restrict us from lowering interest rates, which we need to do in the Reserve Bank's view to meet their targets. So there was a bit of, bit of crossfire there. And there was a press conference around the same time. And I guess all eyes were on Adrian Orr to see how he responded. And he responded in, I guess a relatively calm manner, given the fieriness at the moment.
Yeah.
Now, I mean, some people might think this is a terrible thing, but I think it's quite good because it's getting this discussion out into the open.
Yeah, that's right. And that's the thing, right? Like, I think sometimes you can almost have this sense of suspicion that you think, oh, there's all these deals happening and no one's actually communicating to the public. But this is actually a really good example of how the system works and how it's flushed out a discussion, which we do need to have, because we do need to actually understand what's going on here. Is the government basically giving part of their function over to another agency saying, hey, can you do this? Because it's actually a little bit too tough for us. Is that kind of what's going on here?
Yeah, well, I mean, Grant Robertson, the government has been under heat. So it's in its favour to go, oh, actually, Reserve Bank, what are you doing? And I think it is a fair question to say, look, interest rates are affecting house prices. And that is a fair thing. So they've done that. But then I guess the central bank's gone, right, yeah, sure. But what about supply, government? That the ball's in your court as well. So there's been a bit of sort of hitting the ball back and forth. And I think the pressure's on both of them, central bank and the government, to just acknowledge that there's a problem. This house price inflation is, in my view, getting out of hand. And hopefully that puts pressure on them to do something. So what's happened is the Reserve Bank has now just this week or on Friday written back to Grant Robertson to basically say, you're not going to change the monetary policy remit, leave that alone. But if you want us to look at house prices more, we will do that through the way we regulate banks. So through our financial stability arm. And the Reserve Bank's gone, that just let us do a monetary policy thing, but actually we can change the way we regulate banks. So already it's got the loan to value ratio restrictions, the LVRs, it's going to put them back on. The Reserve Bank's also said, look, Grant, can you give us debt to income tools? So can you allow us to tell banks that they can't lend too much to people who want to take out a lot of debt versus the income? And now this is an interesting thing. The Reserve Bank has for years been calling for the government to give it that tool. Basically just give it another way that it can regulate bank lending. So the Reserve Bank wants it, but it hasn't said it would necessarily use those debt to income tools. With both debt to income tools and LVRs, they're really politically controversial because they're there to protect banks from themselves, essentially, not necessarily lower house prices. But there is a distributional effect, like, there'll be a whole bunch of first home buyers who might be affected by debt to income rules because they'll be seeking to take out a whole bunch of debt and the bank might say no. So it's a pretty interesting, politically, it's a pretty interesting type of tool to use.
Yeah, and so the debt to income ratio will obviously it could be applied to different categories of home buyers as well, right? So property investors would likely have a very onerous debt to income ratio. Maybe it's on maximum 6 times their income, for argument's sake. Whereas first home buyers, in theory, could have quite a liberal one. So I guess there's like fine tuning of this, which kind of helps reduce the unintended consequences. But I guess the back of my mind, I'm just still thinking, are we getting further and further away from what the Reserve Bank's function is by doing these sorts of things? Or do you think that that's actually a reasonable tool to be using right now?
I think that when you're doing, when you are effectively printing up to $128 billion, which is what the Reserve Bank's doing, so their QE or their large scale asset purchase program is $100 billion. They've said they'd buy $100 billion of bonds. They've only bought $40 billion. They've only bought $40 billion so far. And then their funding for lending is they're making another $28 billion available at a low cost to banks to on lend. So effectively that they'll print up to, not necessarily, up to $128 billion. As soon as you're doing that, then that is a huge amount of money. Our GDP is like about 320 billion a year, and this is 128. So that's a huge intervention, and you're basically pumping that through the banking system. So if you're doing that, there needs to be some, you've got to fine tune that, right? Because otherwise, as we've seen, it's just going straight into property. So you pull a massive lever here, then you're going to have to do some tweaking there.
What's next then? Like, because I'm looking at this, I can see all the money coming out of let's just say it's just coming out of thin air. This quantitative easing is injecting money into the back pockets of those who already have. Meanwhile, those who don't have, who are struggling to get in, are being locked out more and more because of rising asset prices. So this our financial markets, the property market, giant sponge sucking up all this new cash. When is it going to either pop and change, or when is there going to be some other dynamic that helps those who have been left behind, because they have properly been left behind with this pandemic?
I mean, I think this is the most important question to be asking. I guess the first thing is that some people will argue the Reserve Bank is doing too much. It's going too hard with its QE and everything. The 128 is not necessary. It doesn't need to have committed to printing that much money. Now, that is a fair thing to question. But hey, they've decided that's what they're going to do. That's what's happening. Now we have to look at the flow-on effects of that. And I do think this is where the government has a really important role to play. And it isn't playing that role, in my view, at the moment, because if you have a house, or if you have a good share portfolio or a good KiwiSaver nest egg, then you would have seen that's doing really well. Like my shares in my KiwiSaver are doing great. But for people who don't have assets, they don't have property or shares or whatever, they're not benefiting from that stimulus. Their wealth isn't increasing. And what's more, the people who don't have wealth are probably low-income people, and it's the low-income people who are typically losing their jobs. It's people who work in services sectors like retail and hospo and that type of thing. So not only is my nest egg growing, but I haven't lost my job, and I hope I don't. But those people are not getting as much. Now, I think we need to consider that, and ways of doing that would be to controversial, but relook at the tax system. I'm not a tax expert, but my view would be to tax income earned from like wages and salaries, tax it a bit less, and tax income earned from capital gain. I'm not sure what's the best way of doing it, but from buying and selling assets, tax that a bit more. So just change that a bit to make it a bit fairer.
But I guess the more we're using the government as an agency to create change and to fix the problems, the less efficient it is, right? Like by default, the government is not necessarily the most efficient organization out there, just putting it out there, if I may. And so if we're giving them yet more and more to do to fix the problems that have been created by intervention, it just kind of creates this interventionist snowball, right? And I just wonder, again, where does it all end?
I suppose that ideally the government creates an environment for people to trade, and for capital to be allocated to where it's meant to be most efficient, and also creates an environment for people who are not able to, don't have the means of accumulating wealth, for them to be supported as well.
So tell me, Jenée, what else are you working on at the moment? What are you watching in particular? So you're at the pointy head of government and all things central bank, let's say. So what are you actually focusing the most on at the moment?
Yeah, I'm looking a lot at housing, and so to go back to this toing and froing between the Reserve Bank and the government, the Treasury, so the Reserve Bank's given its recommendation to Grant Robertson to say leave monetary policy alone, but give us those debt to income tools. And the government's also gone to Treasury and should be receiving advice back soon on what the government can do to try to address this house problem. So I'll be looking at that, particularly something that's been talked about is extending the Bright Line test from 5 years out further. So that is if you buy a property and you sell it within 5 years, you have to pay tax on the income that you earn, and that's excluding the family home. So that's one to watch. Other recommendations that come from Treasury, also like around the RMA reform, just things basically to increase the supply of housing. Something else that the government announced before the election was that it would underwrite. So here's some more government intervention for you. So that it would underwrite property developments that are struggling to get off the ground, because the government was concerned that banks would become really risk averse. Even though there's all this liquidity, they're worried that banks would tighten up and not lend to developers, which would then slow down the building of houses. So the government said we'd underwrite that and put $400 million aside to do that. And it said it would have released a criteria by this point to say who would qualify, what developers what developments would qualify, and it hasn't done that yet. So it said that it's still looking at it, considering options. It'd be interesting to see if that goes ahead.
Well, fundamentally, that is the one thing probably that would work, right? That is within the government's domain, is to actually increase the supply of housing. Like if you increase the supply, you're dealing with the price problem in a much more efficient way than trying to hold back that wall of demand, right?
Yeah, and also Kāinga Order, which is this new agency that was set up in the last term of government. It's been given a whole lot of powers, and that legislation was really only passed, I think it was in August this year, to give Kāinga Order a bunch of quite strong powers to accelerate house building and accelerate large-scale developments, and also look at new ways of financing that. So it's been given powers to essentially put levies on people who live in certain areas to make them pay for the infrastructure in that area. So a lot has kind of happened behind the scenes, or not behind the scenes, like a lot of laws have been put in place and they've just been passed. And now I think this next term of government is we're going to see, well, look, they've got the powers. Are they going to use them?
Yeah. Can't wait to see. We'll see. So progressive home ownership, do you have any thoughts on that? Like as another way to help, first home buyers in particular get into the housing market?
Yeah. I think, and this is an area I probably need to do more work in, but New Zealand, the Salvation Army came out last week and said that it maintained that 20% of all our houses should have alternate tenures. So not just your sort of, traditional model, but things like progressive home ownership or housing co-ops or other types of models. And it just means that the market is more diverse, and there are kind of more options for people with different needs and in different financial situations. So the problem with these sorts of things is it's a real headache for banks, because if you go to the bank and you say, look, I've got this, like slightly more complicated structure, I want to set up a company and, buy shares and do this and do that, and the bank goes, too hard, we've already got the queue of other people who just want to, have a normal house buying situation. We're not going to deal with you. So I think that's an interesting space to look at, whether the banks start working more with people offering these different types of tenures, because that's, I think, the key part is getting finance for them.
Yeah, I think so. And I think that's kind of like, they'll probably do that if there's ever a situation where they're not able to lend to property investors at all, or they're not able to work with other markets so much, and they kind of forced to, I guess. If you take away all the other business, which is really the low-hanging fruit, they're going to start eating the stuff that's fallen to the ground, right? And maybe that's kind of the position that ultimately they have to be in. But yeah, I know what you mean. Like progressive home ownership is something that I've been, quite interested in for quite a few years in terms of fractional property ownership. And it always seems to fall down when you go to the bank and you try to get debt to be able to do this. But ultimately, if there's a way to solve that problem, then there's a way to get that huge group of people into the housing market. Again, it doesn't solve the ultimate problem, which is lack of supply, but it's something, right, to take care of that inequality piece.
Yeah, and the government has provided some funding for community organisations that already do these sorts of things, and I think that's a good thing. But the scale of it is tiny at the moment. So I went to a press conference, this is a few months ago before the election, and they made a big song and dance about this, support that they were providing, but it was a tiny, tiny amount. So the game, they're talking a much bigger game than what's actually happening in the space. And I think possibly the focus might shift now from helping first home buyers to actually just helping people who can't pay rent, because the need is huge. And whilst kind of, young professionals might want to buy their own houses, the wait list for public housing is going up and up, and I think that's where the focus would probably be.
I guess the needs of the many outweigh the needs of the few in this case, where perhaps the importance is on people to feel wealthier, for the housing market to be supported, even, dare I say, at the expense of these people who can't get in. It's almost like they're a small group of people, so we're actually just going to let them suffer more because we actually need to keep the system afloat here. There's a bit of that going on, isn't there?
I mean, entirely. Like, this is kind of the problem, is that our banking system is made up of mortgages. We have 4 Australian-owned banks and Kiwi Bank, and their books are mortgages. And we've got a bunch of small businesses. Their loans are secured against housing. It all our system is really stacked on the housing market. I think the value of our housing supply of all our houses is about $1.3 trillion. Now, I write every day, and I never use the word trillion in the context of New Zealand, other than when it comes to the the value of our housing. So everything is kind of stacked on it, and it creates a situation where the bigger it gets, the more we need to protect it, because if it crumbles, then everything is kind of a disaster. But then the more we support it, the bigger it becomes and the worse the problem gets. So it's kind of a tough one. What I'd like to look into is like, what would actually happen if house prices fell by 20%, which is just back to where they were a year ago. I'd like to see some research on, what impact would that have on confidence? And no doubt people who bought within the past year would be affected. But like the government hasn't done research. I've asked them for it, like research on what the trade-offs are. And I guess it's probably, I'm not saying this is a good idea, but I just would like to know, like, what's the argument for making it keep going up?
Yeah, I know. And like, did we really need 20% in the last year gains to actually keep the economy going, or even, just half that, or did we need any gains at all? But I'm not saying that because I want to give away my capital gains either, but I guess it's just for the greater good, right? Like, is there anything that could be done to sort of help stop inflation happening in the asset space, right? But I guess we're dealing with pretty blunt instruments that they're pulling, lowering the cost of money, increasing the supply of money, more or less is what's going on. So that's going to create these distortions.
Rewinding a few months, no one expected this to happen with the housing market. So a lot of economists and everything thought that the housing market the house prices were going to go backwards. So basically, we thought it was going to be much, much worse than it is. The Reserve Bank front-footed it, went all out, and now this is the problem. The difficult thing is, what's the counterfactual, right? What would have happened if they didn't go so hard with the money printing, with lowering interest rates? And that is kind of the big question. Or what would have happened if they did it a different way? If they did a little bit less top-down through the banking system and a little bit more bottom-up? And that's a question that, if you have the answer, then let me know.
I'll just run my algorithm. I'll be back by midday. But that's the unfortunate thing about this, is that it's hard to do this split testing to see which sort of response would have performed better. But we've got the response that we currently do. We use the tools that we did and that we're currently using. So we just kind of have to deal with it and move forward with the best in the best possible way. So tell me, before we finish up, Jenée, is there anything else that you want to impart to our audience or share with me before I cut you loose?
I mean, it's been an absolute whirlwind of a year, and looking ahead, I just think it's very difficult to know kind of where we're going. Even I'm interested in the vaccines, and good news with vaccine comes out, and then share markets go up, and I'd be interested to see with the share market particularly, and confidence generally, what will happen if, as it turns out, it might be more difficult to roll out the vaccine strategy, and it might be more difficult for countries to open borders. It'd be interesting to see whether the confidence that there currently is, whether that's sustained. That's something I have a big question mark over, and we'll be looking at.
Yeah. Why would you watch anything else on Netflix when you've got this right in front of you, right? And you got a front seat to it. So fantastic. I
know. I started watching a political drama on Netflix recently, and I thought, this is not as interesting as my daily life.
That's cool.
Yeah.
Awesome to love the job that you're in. Well, that's good. I hope that we do catch up again soon, Jenée. So thank you very much for coming on the show today. I appreciate that.
Cool. Thanks for having me.
Awesome. Have a good day.